is actually part of economic globalization. This will create a change in the entire world economy. Capital markets reward you for what you learn that other people have yet to ascertain. I, Dr. G. Shivaranjani, Assistant Professor, BMS Department, deem it a pleasure to be your host and take pride in welcoming our Chancellor, Pro Chancellor, Vice Chancellor, the Principal Office Bearers, Director, HODs, coordinators, faculty members, participants from various institutions and corporate sectors for today's national level webinar titled Indian Capital Markets, the Pre and Post COVID Scenario. I'm sure all of you will agree that the economic impact of the 2020 coronavirus pandemic in India has been largely disruptive. India's growth in the fourth quarter of the fiscal year 2020 went down to 3.1%, according to the Ministry of Statistics. According to the World Bank, the current pandemic has magnified pre existing risks to India's economic outlook. Let us hear a lot more on it from our esteemed guest speaker, Dr. Soheli Ghosh. Ma'am, I welcome you on behalf of the management of Jain Deemed to be University and iNurture Education Solutions Private Limited. Now I request Dr. Ratna Sinha, Senior Faculty BMS Department, to introduce the guest speaker to all of you. Ratna ma'am, over to you.
Thank you, ma'am. Thank you so much. Thank you, Suranjini, ma'am. It's a very good morning, one and all present here. It's my pleasure to introduce the today's guest speaker, Dr. Soheli Ghosh. Dr. Soheli Ghosh is an Dean of Department of Commerce and also the coordinator of the NET Set Guidance Center of St. Xavier's College, Kolkata. She has been awarded PhD in Commerce by the University of Calcutta. At present, she is a PhD supervisor of Commerce in St. Xavier's College, Kolkata, under the University of Calcutta. She has over a decade and a half of experience in teaching undergraduate and postgraduate students in accounting and finance disciplines. She has written 8 books on Indian financial market, focusing on mutual funds, global financial crisis, and investment strategy. She has published over 50 scholarly research papers, numerous peer-reviewed and referred international and national journals, which was that the approved by UGC list of journals and Scopus indexed. She has been awarded Outstanding Professor in Accounting and Finance at the National Leadership Award 2019, organized by Orbit Service Private Limited, Excellence in Management Research Award at the Women Excellence Award 2020, uh, organized by ILDC and AMP, Indo-Asian Best Women Finance Award at the Academic Excellence Award 2020, organized by Red Talk Delhi. She was among 20 academicians in administrative positions as a dean, vice principal, and registrars in the country to receive the Most Influential Woman in Academic Award 2020, organized by Education Ninja and AMP. We welcome you, ma'am, and request you to take over the session. Ma'am.
Thank you, ma'am. At the very onset, I would like to thank Jain Deemed to be University for giving me this opportunity and this great honor. Ma'am, thank you. I thank the Vice Chancellor, the Pro Vice Chancellor, the department, and all the faculty members and students who have joined to see today's lecture. Ma'am, am I clearly audible?
Yeah, ma'am.
Okay, thank you. So, ma'am, I'll begin with my presentation. I'm sharing my screen.
Yeah.
Thank you. Ma'am, is this clearly visible?
Yes, ma'am.
Okay,
Yes,
ma'am.
ma'am.
Thank you so much, ma'am. So I begin with the discussion today. Now, as Dr. Sinha and Dr. Shivaraj Ranjani has already mentioned, in a present scenario, we are already fighting a very tough battle with the coronavirus. And on top of that, for a very long time, our entire financial market, the capital market, the money market, everything has been going and starting a downturn. Now, the point is, in a crisis, as referred by John F. Kennedy, in a crisis, we must be aware of the danger, but always recognize the opportunity. And according to Churchill, never let a good crisis go to waste. Now, there is no doubt the present situation that we are in is a very, very critical situation. And we need to understand a very simple thing. That is, our country and the world has seen many recessions. We have seen the latest global recession, which happened in 2008. And the current coronavirus crisis is very different. Why is it different? We will discuss, and most of you are already aware of it, but it's more of an interaction and a discussion. In the present crisis, what we are facing is not only a global pandemic, but a very large problem of reduction in global demand, loss of jobs, a severe health crisis, which is affecting our Indian market in a very, very adverse manner. But the question is, did only the coronavirus lead to this scenario, or were there any other issues or other problems which have led to this present situation of our Indian market? And the main objective of today's discussion is to understand the present situation. Most of us are already aware what is happening. And more importantly, to understand the reasons behind the present downturn, including the impact of coronavirus. The term here is including the impact, meaning, as many of the experts have already said, that we should not only consider the coronavirus pandemic as the root cause or the sole cause of the present downturn. It did lead to a very, very large effect. Of course, it did lead to a situation where the markets crashed even further. But then, was this the only reason? That is what we are trying to discuss today. And that is what we will have a discussion on during the interactive session or the question answer session as well. So, the 2020 stock market crashed. We already know we had started feeling the effects of this from end of 2019. And the main result or impact of the COVID-19 pandemic started actually showing its effect in the Indian market from early January, or I would say early January, February, that period. Now, obviously, the global economy had already started feeling the impact a little earlier than the Indian market. And there were rising fears, and the global economic shutdown had already started from December. Towards the end of December, it had already reached the sidelines of the Indian market. And by March, we were deep into this coronavirus crisis. As I had already mentioned before, many experts have argued that this is an accelerant. This is what we need to understand, that we were already in a situation where our GDP was falling. There was heightened inflation, jobs were less, we were already in a downturn. And this coronavirus led to a very, very large problem and accelerated this entire downturn, which had already started. Now, for any market, the two main things that we must know for any market, any situation, are the risk factors which are affecting a particular market, our present businesses, and how to overcome those risks. Now, we all know what the kinds of risks are, so I'm just going to brush upon the main aspect which I'm going to discuss today. Now, before we begin the discussion, I would like to take you back a little to the pre-COVID scenario, because until and unless we understand what happened before, we will not be able to understand the far-reaching effects of this present crisis. Now, during 2019, the IMF reported that already the world economy was going through a synchronized slowdown. Now, the term here to look is synchronized slowdown, meaning every economy was not slowing down at the same pace and at the same time. It was happening in a very, very wave-like pattern. And during the 2008 crisis, the same pattern was being repeated slowly in various economies. Now, we had already seen, not only in India, but in the global world economy, we had already seen the consumer markets were already suffering a huge deterioration. Why? Because the global demand was already getting reduced. Now, there were many reasons for it. There was the US-China war. Then a little earlier than that, there was the European crisis, the Greek financial crisis, the Brexit. So all of them were having a cumulative effect in the present, or rather during 2019, before the coronavirus hit. And according to IMF, the geopolitical tensions were one of the main reasons why this synchronized slowdown was happening. Now, why are we discussing this before the pandemic situation? Because nowadays everyone is blaming only the pandemic for this present situation. But as we have already established that yes, coronavirus did lead to a major downturn, but it accelerated the effect. The problem was already there. It was happening in a synchronized way. Some economies were trying to cope up, others were not being able to, and coronavirus led to a larger effect. It accelerated, multiplied the effect, acted as a catalyst into the present situation. Now, as I said, what is the concept of risk? Why do we need to understand risk before we get into the situation? I'll just go through a very small portion here, because pre-COVID risks were different and post-COVID risks were different for our financial markets. And even though today we started at a very good note, the Sensex is at its high, the Nifty touched 13,000 in record. I mean, over the last so many months, this is the highest that the Nifty had reached. But then how we have come to this position and whether at all this can be considered as a stable bull run is what we need to look forward to. Now, concept of risk. We already know the main risk of any business is where the profits are affected in an adverse manner. Everyone knows this. Now, why are the risk elements or uncertainties so important for us to understand? Because unless we know the risk, we do not know how to hedge for it. We do not know how to counteract the risk. We do not know how to plan for it and plan for situations which can reduce the risk. We can never avoid any risk. We all know in the financial market, the situation is so dynamic, so uncertain, we cannot really avert any risk. We can reduce the impact. We can plan for it. So this is just a very brief discussion for in case there are students who have joined in and those who are watching this through the live YouTube streaming. We already know that for any trading commodity, the entire demand and supply and price are interrelated. So the main problem is this variability of the net cash flow. If the variability of this cash flow, or what we simply call volatility in our capital markets or in our financial system, if that is very high, the risk becomes very high because there are a lot of implications of volatility. There can be a downward risk, there can be a value at risk, there can be various other components of risk which will lead to a multiplied and a cumulative effect on the financial markets. Now, obviously, lower risk implies lower variability in the net cash flow. And Obviously, along with net cash flow, it means the returns generated by various schemes or the market price fluctuation of shares, etc. So I'm going to skip this part because I would like to discuss the risk in the financial sector. Now, under any situation, any normal situation, whether it is a crisis or whether it is a pandemic, the main risks in the financial sector, other than, of course, the interest risk, the credit risk, the default risk, we are not discussing those. But then the main problem is a backward financial system. Why a backward financial system? Because if a financial system is well developed, it already has some of the inbuilt features of risk absorption. We will come to that in a while. Paucity of funds, one of the biggest problems that the Indian financial market had been facing long before coronavirus hit us. There was a liquidity crunch in our system for a very long time. And there were NPAs all across the banks, which further led to a major problem of liquidity, a reduction in the growth rate, and so many other problems. Now, unsatisfactory interest structure, this was also creating a lot of problems which were there in a pre-COVID situation. Because as you already know, the interest structure will not only affect the loans, incoming and the overall wealth creation, but it will also affect in a very, very long-term manner our exchange rate and our overall amount of liquidity in the entire market. Lack of adequate capital formation and difficulties of small industries. Now, no matter what we have, the ultimate aim of any financial market, any economy, is capital formation. Because if we don't go through that, if we don't increase the capital formation in our country, it will ultimately lead to the problem of not only a liquidity crunch, but a reduction in demand, which had already started setting in all global economies, including India. And this is no new tale. Everyone knows in general the problems that were being faced by the small, medium sector and micro industries in our country. Even though the government had a lot of schemes available, there were a lot of push being given from both state and central governments and various banks, but still there were severe issues being faced by these small industries, micro, small and medium enterprises. And the startup scenario in our country was also not really very popular, which overall led to a situation of the pre-COVID scenario, the pre-COVID problem. Now, the COVID-19 risks. So basically, for understanding any financial system, pre and post-COVID, pre-COVID, the situation risks we have discussed. Now, I have already said that we all are aware that there are many other risks involved. We already know the default risk, the exchange rate risk, the generic risk of be it a systematic or unsystematic risk, the market risks, everything we know. So I'm only highlighting some points, some areas which, according to me, and of course some other data, I'll be sharing a lot of data with you, would obviously lead to a situation where we consider the overall risks in the light of the coronavirus pandemic. So now if I consider a situation, the current health crisis quickly turned into a financial crisis. We already know the health crisis that we had. Why was this health crisis turning into a financial crisis? Because mainly the financial crisis was already there, and the health crisis led to this lockdown, which led to a severe crunch in demand, which further led to loss of jobs. The entire supply logistics chain was completely stopped. And we already know how businesses were extremely adversely affected. So firms and individuals hoarding capital rather than spending, this was one of the problems which specifically had an impact on the Indian economy. Because what were the firms doing in the immediately post-COVID or during COVID scenario? I wouldn't say post-COVID, we are still battling the crisis, but then at least hopefully we have already covered the main problem. We have avoided the main risk. So if I say during the COVID scenario, the individual firms, especially smaller firms, they were holding on to their capital. They were trying to hoard that and not investing it in scenarios which were obviously going to give returns. The main reason being they were uncertain. There was a prolonged lockdown. The economic impact because of this lockdown increased exponentially. At least some essential services continued, but then in general, the overall problem was faced or accelerated or multiplied because of the coronavirus crisis and the lockdown. This we all know. So if I move on to some of the data sharing, this, if you can just go through once, I would like to point out only one point here. India, like other emerging economies or emerging markets, is also bearing the global flight to safe assets. Why safe assets? Because in the present scenario, the entire asset liability structure of all companies are being looked into in a new light. Previously, human capital, which used to be considered as an asset, that needs to be looked into in a new light. The different kinds of working capital management processes need to be looked into in a new light, and especially the supply and logistics management need to be looked into a new light. Now, the moment the businesses are looking into this, they are restructuring. It is having a direct impact on obviously their market price, on the herd mentality in the financial markets, which is further leading to the ups and downs and the volatility that we were facing, and now somewhat a stable bull run, if I may say, that we are seeing in the present situation. So according to the OECD report in India, this was the scenario till December 2019. I have mentioned the sources here as well, and this entire PowerPoint I will share with the authorities so that the students, in case you want to go through, you can always go through this. So the OECD analytics said till 2019, if I consider this quarter 2014 to 2019, India was already high in 2019 second quarter. Our growth rate was very high. But we know what started happening towards the end of 2019. Somehow the problems of reduced demand, liquidity crunch, problems in the NPA sector, and all problems, especially in the infrastructure sector, led to a slowdown in demand. Now, that accelerated here. The implementation of various reforms had led to a higher growth, but I will discuss this part, why the economic activity had already started slowing down. The first and biggest problem was the creation of quality jobs. India, we already know, is a young city, is a young country. Now, in a young country where the majority of the youth are unemployed, or even if they are employed, they are not matched with the appropriate jobs, it would automatically lead to a reduction in demand. 90% of the jobs are informal. Large share of the population suffers from severe air pollution. We already know that this has further led to an impact on the economy, impact on the business, and overall impact on the finance. Because a finance sector, a Sensex or a Nifty or a BankX is actually a reflection of the overall scenario in the economy. And all these problems had already started showing its impact on our financial markets. The situation now, we already know. As per the OECD report, I have mentioned the source here, all G20 countries with the exception of China will have suffered the recession. We have already seen this, that China is slowly recovering. And India, we went through a recession. Right now, our financial markets are on somewhat a high. And But however, IMF has already mentioned in a report just a couple of weeks back that India may actually plunge into another recession in early 2021 if it does not manage the deep-rooted problems it is already facing. So this was the situation. I am going to discuss India over here. In 2019, towards the end, towards the beginning, we know our growth rate was on an average touching 8. Just before the end of 2019, that is quarter 3, and then 2020 early quarter, for the fourth quarter, if I consider, then this was the scenario. Then in 2020, already we were at a situation where we have reached minus 10.2. These have been taken from OECD. And this is a situation. We are thinking by the end of 2021, probably we will recover. You see, China never went negative in 2020, if I consider the overall statistic. This data has been taken from the end of the quarter, 30th September. Since we haven't finished the December quarter yet, I have taken the data as on 30th September, because otherwise we will not be able to understand the impact, quarterly impact. These are other countries. I'm not getting into the other countries in details. I would just like to talk about United States here. You see, it's already in a downturn. It was in a downturn before. Even in 2019, it was in a downturn. So coronavirus is not the only reason. And it is expected to increase. However, these figures may have changed, or rather will have changed post-December because of the results of the US elections. So G20, if you consider, we Indians are still at a better level in the future. Right now, we are at minus 10.8, or rather as per the the 30th September report, and we are expected to grow at 10.8, which is higher than the average of G20. Now coming to the main thing. How is this overall structure, be it the economic structure, the health situation, the logistics structure, the business structure affecting our financial markets? If you consider, this we already know, so I'm skipping this part because the COVID-19 has affected all the markets all over the world. This was the Nifty, a comparison of pre and post-COVID. I have just taken two very popular indices in our country. There are many more. And later on, if time permits, in another session maybe, or in some other situation, all details can be discussed. But here I have taken only two specific sectors, over here, Nifty and Sensex. Now, on 14th January, when the pandemic actually started hitting and we started realizing its effect, this was the situation. 23rd March, because from 24th March, the lockdown started. And this was on 24th April. I have just taken a month. And we already know the Nifty 50 was 13,000 yesterday. And Sensex had already touched 40,000 in a couple of days before. So from 31,000 and 9,000, the increase to 13,000 and 40,000, I have discussed that towards the end, the jump of Nifty and Sensex is quite remarkable. Now, ever since the problem started, COVID-19 started, the total market cap lost a staggering 27.31%. This is not only a statistic. It has a major impact on the livelihoods of people, on the market volatility, on the market volume. The amount of volume which is being traded on the market had also gone down to a very large extent. And this is what the problem is. Because of this, you already know, people have started selling out shares. There were so many companies which had even closed down, or at least had laid off so many people. They had reduced the structure. There have been multiple problems which these companies have been facing, huge amount of stock lying unsold. And we already know the infrastructure sector of our economy has been affected even worse. Certain sectors have taken the worst hit. Obviously, the hospitality it's still going to take the hit. Tourism and entertainment. Now, we already know that there are so many stocks which lead to this hospitality sector, tourism sector, entertainment sector, and services sector, which actually have reduced to negative value. They are highly undervalued now, and those companies and firms which were actually doing a better scenario or working in a better way have already seen the worst situation. Now, in response to the turmoil, what did RBI and government do? We already know there has been a lot of infusion of liquidity. There has been a lot of extension of moratorium. Now, the extension of moratorium may have helped the common people. However, it had I would say, a negative effect on some of the banks, not all, but some of the banks, because later with a Supreme Court ruling, it was said that no interest would be charged on the moratorium time given also. Then payment deferrals, subdued loan growth, rising cases of bad loans, these were already there, and they started increasing even further because of this coronavirus pandemic. Now, when the banking sector of an economy starts faltering, what happens, we already know. We have seen this before with the PNB case. This is why the big mergers are happening. It is having a direct impact on the Indian financial system. And the capital markets are obviously getting very, very, I would say, directly affected, in some cases positive, in some cases adverse, because of all these above problems. And this was already known. The deceleration of the GDP growth and demand supply chain had led to an overall hiring freeze, reduced travel and marketing spends. Now, there are positive points to that as well, because somehow the Indian companies have worked towards a consolidation which is slowly leading to the increase in the volumes traded in the market in somewhat a bull run. Now, how long this present bull run continues needs to be seen, but then at least from a very dark situation, we are still moving upwards in a better, I would say, towards the light. We can see the end of the tunnel, and we can at least see the light coming from that side. Now, Market Watch, PSUs. This has been taken as on 15th September and 30th September also, more or less, the situation was similar. As I said, I have taken the last quarter's report. Otherwise, we would have been given a skewed idea. So PSUs in the market, if you consider this was the situation, towards the middle of September, the PSUs were already, the PSE index had already become a little bit better. I have taken the comparison from 2009 to 2020, because this was the time when the global crisis of 2008 started having its long-term effects and lagged effects. And this is the situation where the coronavirus pandemic was having its lagged effects. If you see, ONGC, MMTC, Bharat Heavy Electricals, they were all doing well. This data from, again, I have mentioned the source here. The sources are very clearly mentioned. So in general, what are we seeing? That PSUs were some of the stocks which were worth investing, but there was a steep fall in the prices. So whenever a PSU stock is falling, most of us in a normal, the rational mind, we would always want to invest in such a stock because we know ultimately they will recover. Because they are PSUs, even if they do not recover in the way they are supposed to, at least the government bailouts will happen. So what did the country do? Those who are constantly trading in stocks, they started buying these stocks because there was already a steep fall. Slowly, this led to a better market stability in the prices of these PSUs. Not all, some of them. I will discuss that again. What is the situation based on yesterday? These were the stocks which were worth betting on. I'm discussing a few data so that we get an idea of the various financial sectors, the capital market sectors, which were actually doing well. You see the potential gain for NTPC was 48%. These are all very, I would say, strong PSUs with a huge amount of potential, and thereby most of the analysts always said either buy or hold. See, the sell is very few. A majority of the people, experts, and most of the people trading in large volumes of stocks started buying the stocks of these PSUs because they were now priced low due to the coronavirus pandemic. And this would have been the appropriate time to buy because these are quite expensive stocks. And once they are a little low, this is the ideal time to buy. So when the people started buying, the volume traded started increasing again. Now, these were some of the actively managed PSU funds. They were able to beat the segmental index. Can you understand? Even in a coronavirus pandemic, some of these were able to beat a segmental index, meaning people who were still shy of buying stocks were actually buying these actively managed PSU funds. As I said, they were very popular because these are very expensive stocks. And suddenly when the price decreases, we know the coronavirus pandemic will end whenever it's supposed to, by end of this year, once the vaccine comes out, or next year, but ultimately the markets will recover. And we are already seeing the recovery. And this, I would say, was one of the reasons why the market started improving, because people were slowly beginning to have faith. And also we know the lockdowns were also getting reduced. People were starting to work. People had started moving out. Businesses started reopening. Again, the demand started coming in. Some generic trends which we saw post the COVID pandemic hit us. I have the data set, and as a link separately, I can share this with the authorities so that those who are interested in the market scenario analysis, fundamental and technical analysis can use these charts and these pointers. So other than the PSU sector, you see, we can say Cipla, one of the pharmaceutical sectors, doing extremely well. We already know the pharmaceutical sector, the digital communication sector, the banking sector were already doing well. So within the top few, we already see Cipla, we see Natco Pharma, we already see Aurobindo Pharma, Jyoti Labs, Glenmark Pharma. So many are already there towards a higher side. But one thing I would like to discuss, especially because many of us are professors here and professors of finance, that we should never ignore the downward risk. I'm taking my cursor here, the downward risk. Why? Because if you see where Aurobindo Labs, the downward risk is Aurobindo Pharma 2.88 and Jyoti Labs 1.77. They are just one above the other. But then the downward risk, the possibility of this entire stock crashing again is still high. Now, again, this was as of 30th September. And by 31st December, obviously, the entire scenario will have changed a lot because our markets have already started picking up. I will move on a little faster because I guess I have around 20 minutes remaining. These were some of the stocks. I'll skip this part. This is what I would like to bring your attention to. This again has been taken from various sources. The sources are mentioned at the end of the entire presentation. According to the experts, as on 30th September, the fastest growing stocks were Dixon Technologies, PI Industries, Laurus Labs, Divi's Lab. Two of the pharmaceutical industries are already here. And the least expensive were these. Again, you see NTPC already there because NTPC was there in the PSU's watch as well. Least risky, Dr. Reddy's Lab, Cipla. So wherever we are looking at, we are constantly looking at two specific areas. One is the pharmaceutical industry, which obviously did well and is still doing well. And hopefully once the vaccine comes in, will be booming. And the PSU sector. Of course, the other industries also started picking up, but then the focus, if you look at towards the improvement of this entire market situation, there is a multiplied effect. There is, I would say, a cumulative effect of many factors, but then the pharmaceutical sector doing well and slowly the PSUs doing well led to somewhat of an improvement of the present market scenario. The mutual fund sector, so I have discussed till now, if you see the PSU sector, the generic market sector, and now mutual fund sector. I'm sure many of us invest in mutual funds. This was the situation as on 30th September, equity large cap. Already it was generating a return. If you look at a return of 3 months, 3 months meaning 30th September means this was time when the COVID scenario had already caught hold. It had already sunk its teeth deep in our economy. Even then, these few funds, equity large cap, were already showing positive returns. It plummeted. There is no doubt it plummeted a lot. But then with the phase-wise lockdown, with the opening of businesses, we had already started recovering. One of the major reasons why I would say is that India recovered comparatively faster, apparently. Again, I'm saying apparently because post 31st December, we will know the real scenario as to whether the bull run is holding on or whether the fluctuation is mild or whether the volatility is severe. But then apparently, I would say one of the reasons why the economy has somewhat recovered to a very small extent is because of the increased demand. Suddenly, when post-lockdown, we see the health crisis coming in control. People have already started going for their work. Companies have started opening once again, especially the manufacturing sector, where we need people and we need appropriate infrastructure and a huge amount of capital. That is slowly starting to recover. But then, as I said, it's too early to predict what will happen in the future. As per the last 1 month, we would say we are going on a high. Somewhat of an extended bull run may be expected. This is continuation of the equity large and mid cap. This was the equity large cap. The large and mid cap is this situation. If you see, again, the percentage return is this high. This is the 3 month, this is the 6 month. 3 month will obviously be a little less because it had the coronavirus pandemic influence in it. If I look at the multi-cap, I'm specifically looking into the multi-cap scenario because the debt situation is completely different as compared to the equity in the present sense. So therefore, I'm specifically looking into the multi-cap, the equity scenario. Again, some of the funds which were doing well, but then see the difference is huge from 37.75 to 21.16. 57.5 to 29.58. On a personal level, I can say some of the mutual funds which I had invested in, which were running negative even pre-COVID scenario, they were running negative. They have suddenly increased. They are in the high, they are rising. So therefore, for whatever reason, whichever way you consider, the markets are somewhat being able to absorb the shock of this coronavirus pandemic. Then we have the equity mid cap, equity small cap. Again, if you see, the difference is a lot. Equity small cap, we see a reverse situation in some cases. Why? But not too much, because some of them have already invested in pharma sector. So therefore, depending upon which sector of the economy or which type of industrial sector this particular fund has invested in, the increase or decrease is according to that. If I consider the equity ELSS, thank you. If we consider the equity ELSS, Canara Robeco Tax Saver Fund, all of them have been suffering a loss, but then not a negative turn, as in a cumulative negative turn. I'll move on to the next part. I'm discussing a little bit of debt. If you see, the fluctuation is comparatively less as compared to equity. Now, we already know debt as an investment tool is much more stable, and obviously it leads to, this indirectly has an indication as to how the debt situation in our market is doing. See, post the COVID scenario, with the amount of moratorium being given to various companies by the banks and the infusion of liquidity, the companies' stability have improved in some cases. Plus, there have been mergers of many banks, which have overall led to comparatively looking at the NPA sector, especially in the banking companies, in a different way. Therefore, The debt structure, the debt scenario in our country is comparatively slowly recovering, but I would say equity is recovering faster than this. And the major reason why this is there is because we still need to improve our infrastructural scenario. The infrastructure industry, the manufacturing industry is still largely hit with a demand crunch and with a severe problem of supply logistics. I would not discuss this. I will move on to some closing trends. I have discussed as on 25th September as well as yesterday's. So some of the closing trends towards the end of September were these. If you see S&P BSE Sensex towards 37,000, Nifty 50 was 11,050. I've taken all the data, but I will discuss specifically Sensex and Nifty. Ma'am, do I have another 10 minutes?
Yes, ma'am, you can.
Okay, thank you. Thank you. So if I consider the S&P BSE Sensex and Nifty 50, it was already up. As compared to July, it was already up. But then pharmaceuticals had done even better. These are some of the trends which are going to help the recovery in future. Once again, I would like you to remember these 2 points or keep this in mind. As on end of September, this was the situation, 37,389 and 11,050. And we already know what is present, today's trend. I have the data for yesterday's closing. So Cipla, we already know, had received a huge approval, which has further led to consolidation. Now this is considered as a stable stock. Zydus Cadila had again received an approval from US FDA. Yesterday itself, there was another approval which was received. And this has further led to a consolidation of all these pharmaceutical stocks and ancillary industries with the pharmaceutical stocks, because pharma industries do not work in isolation. They need a lot of course, a lot of import also happens, a lot of export is already associated with it, and a lot of ancillary industries are associated with this pharma sector. Engineering. Now, we already know RITES has been awarded the turnkey project. This is a huge amount of, I would say, infrastructural boost to some of the companies, because again, these do not work in isolation. Once the infrastructure sector gets a boost, automatically the economy will start improving. And we have already seen the effect, because this was as of end of September, and we already know the markets have improved even more. Some GMR infrastructure, they also announced definitive agreements, which has also led to an increased stake. Capital goods sector. Now, the company would be doubling the range of the refrigerator segment. We are always saying that there is a demand crunch, but then in some goods, I've taken just one example. There are many examples which are around us. There is an increase in demand of certain goods. There's an increase in demand of certain products in this new normal. Oil and gas. Now, this was one sector, even though there has been improvement, but still the overall demand of oil and gas in general has come down because, of course, the transportation, air traffic and all these have reduced. So in general, the demand is slow. But post the opening of the economy, as in post lockdown, again, slowly, at least the regular transport has increased. The transport, the travel within India has increased. Of course, there will be bubbles, air bubbles here and there, which we will have to look into later. NBFC and finance, an extremely important sector, which we need to see, especially which I feel has led to an improvement in our overall economy, because the finance sector, with the moratoriums, with the mergers, with the infused liquidity, and of course the overall packages which were being given, spot packages being given by the government, has somewhat been stable. Because of the essential services sector, also in general, even though initially the amount of loans taken were very less, the amount of savings had increased. In one of the lectures which I had attended around a couple of months back, the past general manager of UCO Bank had mentioned that already we have started seeing a huge amount of increase in parking of funds, as in people are now parking their funds. And thereby, what is happening? The amount of liquidity available with the banks, money available with the banks increased, which had led to a kind of a better situation. Their balance sheet improved. However, as I said, this needs to be divested. This needs to be invested. Loans need to be given out. The amount of investment has to increase, not only savings, otherwise wealth creation, this trend will not be continued. Information technology, a huge boost to all the information technology sector because of online meetings, online teaching, online conferences, the new normal. So the demand has increased. The sector has boomed a lot. And therefore, this has also led to one of the areas where this is having a positive impact on the economy. But there are still problems. The major problem that our country is facing are the structural issues. Some companies, especially as I said, infrastructure companies, manufacturing companies are still in a very, very dark place. And unless this demand, this overall structural demand increases, we may not be able to hold on to this bull run. Now, if I move on to generic suggestions, before I move on to this, I would want to discuss this situation. This is taken on November 24th, the BSE Sensex trend. It is at a high, opening at 44,341. The previous slide which we saw was as on 25th September, it was around 37,839. And this was opening high, low, and it closed at 44,000, from 37,000 to 44,000 in a matter of 2.5 months. Again, as I say, is not a matter of joke. So if you see from the end of September, that is the end of our second quarter, and continuing almost hopefully towards the end of the third quarter, the market has already started improving. This was the scenario in August. If you smoothen out these intermittent fluctuations, then you will find that there is a positive upward trend starting from August. And 44,000 is quite a high. These are some of the companies: Asian Paints, Axis Bank, Bajaj Auto sector slowly improving, finance, FinServ, Bharti Airtel, communication sector, HDFC, already started increasing. Percentage change is already a positive one. Some other companies also I've mentioned here. I'll move on to the next part. Nifty 50. If you consider from 31st August, this was the situation in September, which was around 11,000 as we had discussed. And now if you see, yesterday it reached to a new high of 13,000. This is as on November 23rd. That is on Monday. So we already are seeing a positive impact of all these companies and the overall Indian market scenario. Adani Ports, again, obviously Asian Paints, Bajaj Auto, Bajaj Finance, Bajaj FinServ. So these, in a cumulative manner, led to an increase. See, the volume of trading is also increasing. So if I look at this, some of the major notable change makers, or I would say generic suggestions, would be, in order for us to hold on to this particular bull run or the positive side of the economy, one of the major aspects that one must look into is we need more of sector-specific capital consideration. See, some sectors need special attention. The manufacturing sector, the MSME, the rural sector, we need more investment in these sectors in order to make an improvement in the overall economy. The main silver lining that we already have is COVID-19 is at least hopefully under control. Whatever the problems that may have been faced, at least in health-wise situation, India is somewhat prepared, at least as per the reports say. Now, if India is somewhat prepared and we do not enter into this second run once again, or second wave as the experts, the health experts are calling, then we do not fear another lockdown. if the lockdown is not happening again, then the businesses will continue as it is. And with this constant support and push and the vaccine coming in, at least the news of the vaccine coming in, we may actually be able to ride on this high bull run. We have seen the trend which the Nifty and the Sensex was there since August, somewhat of a bull run. Of course, intermittent fluctuations will always be there, but then smoothened out. If we can ride along this bull run, we should be able to actually negate the IMF predictions of India entering into its worst recession in 2021 early quarter. However, it's very easy to predict now, but then it is extremely uncertain because, as we know, we do not know what is going to happen tomorrow because of this coronavirus pandemic. Some notable change makers. Some examples I have taken here: Serum Institute, of course, One Pharma sector, Paytm Mall, because a lot of payments during this entire crisis situation have been online. Now, this happened even during demonetization. This entire problem was already solved. And now I would say Paytm and other such wallets, the increased mechanism has started because people were already going for no cash deliveries, no cash transactions. Grofers, essential, because these companies started becoming a part of the essential services. So some of them are notable change makers in our pre and post pandemic scenario. Lenovo India, BSC, HUL. Again, some of the government sectors, PSUs, as I said, they were doing extremely well because even though they were actually going down, people had enough faith that ultimately they will boost up. So a lot of people bought such shares, which were extremely expensive before, but now were within reach for many of the traders. So coming to the last part of the lecture, if I consider this entire turn, there are many other companies. And as I said, I have only taken the snapshot of the first few. There are many companies within Nifty 50, obviously, they're all 50, and for Sensex 30, all the 30 companies data I will share immediately after this lecture so that those who want can have a look and can understand the scenario a bit better. But I would like to bring, in the last 5 minutes, I would like to bring focus on one specific aspect. See, even if we consider the run, this is a very high jump. From 2nd November to 23rd November, this is a very high jump. As compared to a comparatively flatter curve, this is a very high curve. So it's extremely difficult to predict now whether this will continue till December. The same thing is there even in Sensex. If you see, this is comparatively flatter. However, there is a huge jump from the first week of November till 23rd or 24th of November. So there may be various reasons with it. The US elections, the festival season in our country, the announcement of various vaccines, more packages being announced by government, better economy as in more industries opening up, better stability in many stocks. So it's a big question whether this will continue in this sharper trend, because we already know this is already at its highest, almost at its highest. So we should be very careful to see the next drip. So the moment that there is a high point, we hope that it does not reach its resistance level as of now, and we can continue with this high bull run. In terms of any capital market, financial market, or any, especially in our Indian sector, what needs to be done to maintain a healthy structure is infusion of capital, especially, as I said, in the manufacturing and infrastructure sector. And the services sector needs to be opened up soon in a proper manner, because a huge amount of the Indian market is taken up by the services and the tertiary sector. So with this, I would like to end my discussion. The last few points, one of my favorite people, I would say, someone I always look up to. Nothing in life is to be feared. It is only to be understood. And now is the time to understand more so that we may fear less. Because we can never predict the next pandemic. We can never predict what risks we are going to come up with. We can never predict what is going to happen in future. What we can predict is understand the situation, learn from our mistakes, and be geared up. So many of us often say that what is the way out? Technically, there is no one solution to the way out. We need to look into smaller aspects, do more fundamental analyses, and find out where we are headed towards the future. With this, I would like to end my discussion. Thank you everyone for your patient hearing. And if ma'am permits, then we can have our question answer session now.
Thank you so much, ma'am.
Thank you, ma'am.
Participants, now the session is open for question and answers. We have already received a couple of questions in the chat box. I will read it out for you, ma'am.
Yes,
We have
ma'am.
one question from Mr. Shivananda Kumar. Sir asked that, can we believe the growth of market is a real growth? It is clear that manufacturing sector suffering a lot, but market growth.
Right. Thank you so much, sir. A very pertinent question, because there is a big controversy here, because some reports are indicating that this is not a real growth. Because as you rightly mentioned, and I have also mentioned during this entire discussion, that manufacturing sector, infrastructure sector is already seeing a very, very bad scenario. It is improving very slowly, but it is still in its very, very dark situation. So real growth can only be understood, as I said, towards 31st December, because as you see, this growth can be due to various effects. It can be a temporary volatility because of the festive season, the US elections, the announcement of the vaccine. But then whether it is the real growth can only be looked into in a long-term scenario. So until and unless we reach the end of the third quarter, that is December, it is very difficult. Some of the reports will say the real GDP growth, the real growth in a sector is so much. But then I would say that we must be cautious, because for the time being, this real growth, or growth which is being considered as real growth by some of the dailies and some of the experts, is still to be tested. And probably, hopefully, I would say by the end of the third quarter, that is December 31st, we will get to know whether truly this is the real growth. Because apparently the major, I would say, pillars of our economy, the infrastructure sector, the manufacturing sector, is still in a very dark scenario. So we should be cautious. I personally do not feel that this is the true indication of real growth. But as I said, experts, other experts, many of them agree with me, many of them differ as well. Thank you, sir.
Also, his question continues stating that, what about scheduled banks?
Yes, this is a very, again, as I said, a very relevant question, sir. We have already seen the huge mergers which are happening, be it with PNB, be it with SBI, the mega mergers with scheduled banks. I would say it's time to consider this as real, because even though the NPA problem was huge, pre-COVID also the NPA problem was huge. We have already seen the situation with Yes Bank. We have seen with NBFCs like DHFL and others completely tanking. And very recently, we are seeing Lakshmi Vilas Bank and so on and so forth. But I would say, post the moratorium, and because financial services sector has been continuing as an essential service, the amount of liquidity is there because the savings have increased. But if they are not able to actually distribute that fund by loans, by giving out cheaper loans in the hands of the people so that they can actually invest and bring the economy back to track, I would say this growth would suffer again. But then the scheduled bank sector, I would say, is in a much better position as compared to our infrastructure, manufacturing, and services sector. Have I been able to answer your question, sir? I mean, I hope this was the question as in asked. Ma'am.
Yes, ma'am.
Okay, yes, ma'am.
To the next question, ma'am.
Yes.
Dr. Muthi Reddy asks, like, how to balance market inflation?
Thank you. Thank you, sir. Sir, this is a very critical question. Balancing market inflation has always been our Achilles' foot of our economy. The inflation right now, actually, a certain amount of inflation would probably be good, but then we are already in a situation where the inflation is out of reach. So I would say one way of considering this is providing, this is my opinion, if we provide cheaper loans, and instead of actually moving the demands towards just the consumer section, we can actually move the investment in maybe real estate to a certain extent and in new functionings of manufacturing. That is, companies taking cheaper loans and starting off with their manufacturing sector or building new projects. This may ultimately lead to a better control in the inflation because, sir, as you already know, the indices that we are following, it's a very, very contradictory situation in some of the indices, where one sector is doing so well, the others aren't. So inflation as a whole, there is a dichotomy here because if we infuse too much of liquidity and too much of money in the hands of the consumer, then again, demand for certain goods will increase, which will again have a negative impact, thereby increasing inflation. So probably the channeling of the funds and the investment criteria, the investment of companies in sectors which require a development would, I feel would probably help in reduction of this, or at least stabilization of this inflation. Thank you.
Ma'am, we have the next question.
Yes, ma'am.
Ravinder Shihar.
Yes.
Sir asked how we improve our capital market structure.
All right. Thank you, sir. Thank you for the question. I would say it's a very long drawn scenario. Now, in a capital market, as you already know, it is a combination of all the sectors of the economy. So in the present scenario, as we already saw, that there are certain sectors which are doing very well. And one of the surefire ways of improving the capital market scenario and making it a properly well-developed market is higher volume of trading. Now, that can only happen if there is healthy volatility. What do I mean by healthy volatility? Unless there is volatility, no one will buy and sell shares. But then if the volatility is too much, it will create a problem. Now here, the sectors need to come in together. As a combined effect, there will be a situation where we need to find out which sectors require improvement. So I would say if right now we have the manufacturing and the infrastructure, services, tourism sector, if they are given a boost, then probably the present scenario of the capital markets could improve further. And however, as I said, this is related mainly to a very basic problem that our markets are not that well developed yet. We are developing, but the capital markets need to be well developed at a faster pace. They need to develop at a faster pace. Thank you, sir. Thank you, ma'am.
Yes, ma'am. We have another question.
Yes, ma'am.
According to your opinion, how far the public is responsible for the present situation?
Ma'am, I would say thank you for the question. I would say we are responsible to a very large extent. Number one, if you say the present crisis, I will go a little bit pre and post. Pre-COVID, what happened was we were probably more interested in some consumer sectors as compared to real-time investment. Now, that would include the big companies, the government, and the public. Post-COVID, what happened was, of course, our entire consumer demand got very badly crunched. We have started living on the, ideals of minimalism. And that is why there is a continued decrease in demand. Or at least the demand is not increasing. If I do not use the term decrease, at least it's not increasing at a faster rate. So the public is, of course, responsible for it because I'll give a very simple example of mine. I used to trade a lot in the market. Post this pandemic, I have stopped. Why? Because I am also cautious as to which particular company to invest in. So thereby, my investment pattern, and along with it, so many other people who trade normally, their investment patterns are changing. So if I look into the behavioral finance sector, then obviously the mentality, the aspirations and the predictions which the general public are feeling and which is directly getting affected in the stocks is having an impact on our capital markets and of course in the present situation as well. Thank you, ma'am. Thank you.
Thank you, ma'am.
Thank you.
There's another question from Binod Roy.
Yes.
What is the impact of economic and information globalization on the functioning of international financial markets?
Okay. Thank you, sir. I will be answering this as a generic question because since you did not mention the pre or post COVID situation, I would say it has a very positive impact. Because if you consider the global, we are already a globalized economy. We are already having a lot of foreign influence in our overall market and our economy. So until and unless we consider the overall growth, including these impacts of the sectors which you mentioned right now, we will be isolated. So therefore, I would say it has a very positive impact, but then we have to have enough shock absorbers to, I would say, guard ourselves with the international influences as well. Why? Because the moment we open up this international influence, the negative influences of a Greek financial crisis or a Brexit or a US-China trade war also starts seeping in. But then I would say that we should not be worried about the negative impact. We should take it in a larger positive way. And of course, I would say it has led to a far-reaching effect and it has helped in the growth of the economy. But post-COVID scenario, I would say it is very wrong for me to say if this is having a positive or negative impact, because as you know, we are actually at a precipice. If we do not control this coronavirus crisis, be it in the health sector, be it in the economic scenario, we are about to plunge into a low because we are already riding high on a bull run. If we do not continue, it will fall. So thereby the international influence and our international financial markets need to be analyzed in a better light because there are many influences which are coming in other than the Indian context, because in many countries, the second wave of the virus has already started. So again, there is just that synchronized slowdown or volatility, which has again started happening. If we do not curb that in our country, we may again fall into that immediate scenario which happened in March, April, and May. Thank you, sir. Thank you, ma'am.
Yes, ma'am. We have a question from Sagar.
Yes.
To make profit, trading is better or investment? How much capital does a beginner should start with?
All right, that is a very relevant question. I would say if you want to start with, if you're looking at it from purely an investment point of view, as in investing in stocks or shares or mutual funds, then initially I would say you start off with an amount which is at least 1/10 of your salary, whatever is your salary. And if you do not have responsibilities like a home loan or an educational loan or other responsibilities, then maybe 1/5 would also be good. However, if you're planning to start a business, as in a startup or investing in a sector in terms of a sole proprietorship or in terms of a partnership, then I would say be a little cautious, because a certain amount of capital you will get, because banks are willing to give out loans now. They want to increase the wealth creation. They are willing to give loans, but then be a little cautious, because as you know, the present scenario of supply chain logistics need to be very carefully understood. So there again, I would say, if you are planning on starting a business or a startup or something like that, then probably 60 to 70% you should be taking up from the banks, and the remaining 20 to 30% should be your own capital infused, because you need to survive this present pandemic. And investment purpose, as I said, ideally you should start, if you are risk averse, start with an SIP in a mutual fund. If you are moderate risk taker, start investing wait for a little while, start investing towards the end of December, because of course the markets will come down. No matter how positive we are, this extended bull run cannot continue beyond 31st of December, because it will come down. We are hoping that it doesn't fall a lot, but then maybe you should wait a little while and then start investing as the case may be. Thank you. Thank you, sir. Thank you, ma'am.
Yes, ma'am. Thank you for that. We have another question from Prasenjit Roy.
Yes.
Ma'am, is it safe for us to invest in mutual funds now, or should we wait for the correction in the market? What should be the waiting period for an individual investor?
Right. A very relevant question. Thank you. First and foremost, if you are investing in debt funds, this is the right time. It is safe enough. For equity, ideally, you should wait for the markets to correct a little bit. Because as I said, right now the prices are very high. So even if you invest in a mutual fund, assuming that it's an equity-based fund, you will actually have to pay more in comparison to number of units which you buy. Alternatively, if you wait for a little while, as in probably, as I said, end of December, by then we will know the real GDP growth, we will know the actual scenario which we are at present, then I would say it would be the right time to invest. And I will always say, if the markets are in a bearish trend, invest in an SIP. If you have enough lump sum amount, then you can invest that as well. But then don't expect immediate returns, because this entire cycle would take at least 3.5 years. So if you are in for speculation, then stocks are the right thing. Otherwise, mutual funds, invest by end of or mid of December, when the markets are a comparatively lower place than 44,000 and 13,000, as in Sensex and Nifty, and then probably you can invest. This is my suggestion. But debt, this is the right time to buy. You can invest in debt markets right away. Debt funds, I would say. Thank you, ma'am. Thank you, sir.
We have a question from Utsav Agarwal. What are your views on the permission given to private companies like Reliance, Tata, Birla, Adani, etc. to open their own banks?
I would suggest that I am not very comfortable with that. I will tell you why. Because, of course, we already saw in the banking sector what happened towards when we had that Narsimham committee. Then they said we need more banks. So more banks came in. From centralization, it was a decentralization move. Then right now we are facing mega mergers. So I would say, if we want to control the NPA crisis, which we are already deeply into, then personally, I would not say that this is a very good move. And to quote Raghuram Rajan, we should be extremely cautious, because the moment these extremely large industries and players in the market start having a direct hold of the banking sector, then they will start influencing the rates, which may not be good in the long term. So we should be cautious. It's too early to say right now, but then we should be extremely cautious so that we do not see or do not make the same mistakes that we saw with a Yes Bank or with a PNB. Thank you, ma'am, for the question.
Thank you, ma'am. We have a question from Bijoy Pal. Ma'am, according to your opinion, which sector will face stable growth in the opening of 2021?
Number one, pharma sector, because the vaccine is being announced, and no matter what, by the first quarter of 2021, some sort of vaccine will be available. Whether it's 70% efficacy or 80% efficacy, we do not know. But then some kind of vaccine or new drugs will come up to combat this. So pharma sector, I have a strong feeling that slowly the tourism sector will start opening up again, services sector. But for stability, I will always say the information technology and communication sector and pharma sector. If we can infuse appropriate leverage to the manufacturing sector, then it may lead to a stable development. But then, as I said, if we consider, so we will be able to find out probably by end of December or early January as to which sectors are stable. But as per my predictions, I would say predictions, my assumptions, pharma will continue. Banking sector is slowly more or less stable, and the information technology and communication sector. Thank you.
Ma'am, we have a question from Dr. Rachna Saxena.
Yes.
Ma'am, would you like to have your opinion on the observation that market automatically moves towards normalcy, an average that will largely contribute in recovering from COVID impact? However, it will take few extremes before averaging prevails.
Yes. It's a very nice question. Thank you, ma'am. Uh, Normally, why we say that the market corrects automatically is because of the behavioral finance concept of herd mentality. Because ultimately, when the prices are following, people will buy stocks and automatically we will reach the support and resistance level and the cycle will continue. However, what needs to be seen is how long that takes. That is, until and unless some extreme measures like infusion of liquidity, moratorium for banks, more cheap loans for infrastructure sector, unless those are infused, companies in those sectors will not do well. Once the companies in those sectors do not do well, it has a cumulative effect on the overall market scenario, which leads to a problem of delayed correction. Because automatically it will get corrected. We already know through technical analysis that there are so many influences, or I would say receptors, which lead to the automatic market correction. But then they cannot be done in isolation, because ultimately a market is what? It is a reflection of the company's health. Different sectors, different companies, different industries. So if the sectors are not boosted in the appropriate manner, it may not lead to an immediate correction. So the government or the overall economy needs to be steered in a direction where the basic sectors, the pillars of the economy, need to be improved. And then probably, as you said, that automatically markets will correct. But the duration is what we are worried about, because if it takes another 5 years to correct itself, then our financial market and our financial system will again fall further below. Instead of becoming more developed, it will start deteriorating. Thank you, ma'am.
Thank you, ma'am. We'll close with this last question.
Yes.
We have this question from Satyam. Ma'am, how can we approach angel investor for startup if we have an idea? How do we connect to angel investor?
All right. Though this is not really relevant to the topic, but still I would love to explain this to you. I would say, in my basic experience, there are many angel investors which are available, the information which you will get from various websites. I have a book on this, on entrepreneurship. Probably you will be able to find that not only in this book, but then in many other books which are available, how to connect with it. The basic structure is you need to create a plan which is viable. And before you approach that angel investor, a feasibility study should be made by you. Either you do it yourself or you do it through an outsourcing, because an angel investor will specifically look into the viability at the end of the term, whatever term you're thinking of. So a feasibility and viability study, I would suggest something which has a long-term impact. Don't come up with a plan which has immediate gains, because an angel investor, unlike a venture capitalist, an angel investor believes in your plan. The angel investor wants to invest in your plan because that is true to his cause or true to his objective. So thereby, think of a long-term scenario. If you come up with something which you are thinking will break even very fast, it may not happen in this post-COVID new normal. So think of a long-term plan. There are many websites, ma'am, right now I don't remember, but then I will certainly give a list of websites which are there for connecting with angel investors. Also, there are certain governmental websites also, Entrepreneurship Development Cell of the West Bengal government and various other governmental institutions also can connect you with these angel investors. So, ma'am, with your permission, maybe at the end of the lecture, once I send this PowerPoint, I will give a list of the angel investors as well. The references will be from websites and my book.
Thank you for that.
Okay, thank you so much.
Request the participants to kindly turn on your videos for a photograph session. Ma'am, you have been receiving a lot of appreciations and you must read them all by yourself.
Ma'am, at the end of this, I would like to thank you for giving me this wonderful opportunity. And as I said, it was so nice to hear so many questions and interact with the fellow learners, because I always consider myself as a person who's learning every day. And it has been a great honor to meet with you, even though virtually. And once again, thank you so much. Thank you, everyone, for the patient hearing. Thank you for the lovely questions. And thank you for joining the session. Thank you, ma'am.
Yes, ma'am. Great is the art of beginning, but greater is the art of ending. I extend my sincere thanks to Dr. Sohaili Ghosh for sharing her valuable insights in a nutshell on Indian capital markets, the pre and post COVID scenario, and also for accepting our invite amidst her busy schedule. Thank you so much, ma'am. My heartfelt thanks to the management of Jain deemed to be University and iNurture Education Solution Private Limited for extending their full support in organizing this national webinar successfully. I thank all the participants for your active participation and patient listening. Dear participants, the feedback link is posted in the chat box. Please fill by 12 p.m. You will receive the e-certificates within 10 working days. Looking forward to meet you all in another interesting session. This is Dr. G. Shivranjani and Dr. Ratna Sinha signing off. Have a pleasant day ahead. Thank you, one and all.
Thank you,
ma'am.
ma'am. Thank
Thank
you all.
you.
So much, ma'am.
Thank you. Ma'am, I'm leaving the meeting.
Yeah,
Yes,
ma'am.
ma'am. Thank you so much, ma'am.
Thank you.
Thank you so much. Thank you, ma'am. Thank you, Ratna, ma'am. Thank you.
Thank you, ma'am.
Thank you.
Thank you so much.